We see three main reasons behind the strong performance this year. Stabilization in oil and commodity prices, stabilization in US dollar, and a reversal of sectoral performance, by which I mean that mining and energy have been the strongest performing sectors this year, and exporters like Brazil, Peru, Colombia, and Russia were the strongest equity markets. We see several factors that could push the margins in these countries to return back to their long-term historic mean. The first reason has to do with commodities. Most of emerging markets are actually importers of energy and commodities, so lower prices mean for them lower costs and higher margins. Secondly, the currencies in many countries like Brazil, South Africa, Kazakhstan have depreciated substantially, and the producers in these countries are now more competitive against the imports from developed countries. The next reason has to do with the governments who are struggling with increasing cost of debt and decreasing export revenues. And last but not least, all the long-term growth factors for emerging markets are still valid. The populations in these countries are growing, India is booming, the situation in Russia is improving, Turkey is growing at 1.7% per year for many years, and Sub-Saharan Africa is growing at 2.7%. So to summarize, we remain strong believers in the long-term growth of emerging market economies. The markets have been oversold, the sentiment is quite poor, and the external environment is becoming more conducive. So we think that perhaps it's a good time to take another look at this asset class now.